Welcome back to Rockstock Channel. It is Sunday, October 15th. We have a Will Adams from Fastmarkets, which was recorded by Rodney and Will last Friday on the back of the conclusion of LME week. I was not in that video as I got sick, but I just wanted to flag Will is, I don't know, his fourth or fifth time coming on the podcast. He was one of the earliest interviewers that we did back in 2019 when we launched Lithium-ion rocks. And he was very right in 2018, 2019, being fairly bearish. I remember I listened ahead of that podcast to a 2019 interview we did with him, which was Rolling Stones themed. And that's of relevance because Rolling Stones are, coming out with their first new album in 18 years, Hackneyed Diamonds, this week, October 20th. Strongly encourage all of you to listen to that. So it inspired a Rockstock Channel or Lithium-ion rocks narrative back then, and it is inspiring an upcoming narrative in the Lithium Bull, which will be coming out later this week. And again, that's been a little bit delayed because I had a short illness. But I'm fine. Thanks for caring. Thoughts and prayers, by the way, out there to all of my friends in Israel. Terrible events happening in the world, which are influencing a lot of discourse, out there. But I just want to remind you, again, this is a very good interview. Will Adams is actually a bit more upbeat in the near term than he was, 3-4 years ago when he was expecting prices to continue to fall. And he was right then. And I think he's right now. In advance of the Lithium Bull coming out, just want to remind you, please register your email at rkequity.com if you don't already get the Lithium-ion Bull directly. And if you like this video, please like, subscribe, comment, click the notification bell, and make sure to tune in to some other recent videos we did with Pilbara's Dale Henderson, Jonathan Buick at Champion Electric Metals, and follow Rodney and me on Twitter, at Rodney Hooper 13, at Lithium-ion Bull, and at Lithium-ion Rocks. And finally, we did a Twitter Spaces with Jordan Giesige. That's not currently listed on a Rockstock YouTube page, but if you follow me on X, just look last week at that very popular commentary, and Jordan published the fifth and the final chapter of his lithium, 2-hour lithium video, where he's arguing that Tesla's 50% growth expectation of EVs per year is at risk due to lithium supply. So would encourage you to look at all that. And with that, I'll stop the intro and take it away, Rodney and Will.
We are welcoming back Will Adams, who's been on the channel a few times. Will, how many is it? 2 or 3 at least?
Yeah, I think it's 3 times.
That's good. Unfortunately, I don't know, we always seem to time it when we're coming out of or going into tough times, but I'm hoping you've got some upbeat commentary for us today, because it feels like we've all been caught out a bit. When I've looked back, as I think the build up in inventory at the end of last year and the sort of undersupply and push in prices has had a longer lasting effect than I thought it would. What are your thoughts?
Yeah, I think what we've got is we're in the sort of the aftermath of that supply response that we saw last year, second half of last year, when we saw an increase in DSO shipments. We saw lepidolite in China, and that sort of increase in supply has coincided with weaker, probably than expected demand. But I think demand is actually relatively strong. It's just weaker compared with the sort of the gains we were seeing last year. So I think the market has, the sort of production side has geared up and increased more capacity, and to counter for even stronger growth than we're currently seeing. And that's meant that we've had a build-up of inventory over the last 6 months, and we're in the sort of the process of sort of working through that inventory. And it's the inventories, I think, shifted from down from the sort of midstream, more upstream, but we also have quite a lot of inventory at the EV level. Even though car sales are good, you can see quite a build-up of inventory at the OEMs, but also at the dealerships as well in China, and that's been another factor as well. So, yeah, we're at the moment we're starting to see some production cutbacks in sort of lepidolite in China. So that's the process is starting to correct itself, but at the moment prices are weak.
Before we start today's video, we'd like to thank Lithium Royalty Corp, listed on the Toronto Stock Exchange, ticker symbol LIRC. We'll share more later in the video.
If I were to ask you in terms of how would you apportion the inventory that's left between downstream EV, battery cell, cathode, and upstream, where would you say the sort of biggest bottleneck is?
Where the inventory is the lowest, let's start it that way, is at the cathode manufacturers. And I think you've almost got a U shape. You've got upstream, you've got at the processors, you've got inventory. It's quite lean at the CAM manufacturers. They have destocked, and I think we're talking there stocks of 2 or 3 days rather than weeks. Whereas in the OEMs and in China, the OEMs and the dealerships, you've probably got a month's worth of. You've got something like 600,000 units of EVs. So that's higher than it should be. So I think I think one of the reasons for that is China itself. One of the big drawbacks or headwinds we've had all year across the commodities is China has not bounced back as fast as it was expected to after relaxing its COVID lockdown rules last year. You look at the housing market in China, the property market in China, a lot of household wealth feeling is tied into those property markets, into the prices. If they're down, then they're probably holding back on spending on high ticket items like EVs. I think that for one of the, probably not quite the first time, but the economic cycle is having a bigger impact on the EV market, on the lithium, on the battery market this time around than I think it has in previous sort of economic cycles.
Well, I would say one thing, Will, when I look at wholesale numbers versus retail numbers in the Chinese EV market, they look to be not too bad. It looks pretty healthy.
Yeah, so you're looking at, you've got, I think, January, September, you've got 30% growth, in EVs. But in the same period, over the whole of last year, it was 96%. So if people were gearing up for another very strong year and they've built more capacity and they've been pushing utilization rates as well, then that's why the stock has built up, because 30% growth is fantastic, but it's obviously not as strong as it was. So there's that sort of expectation. It's a relatively slower growth. It's still very good growth. And we're seeing really strong growth, in the US as well and in Europe. So I don't think it's a demand. Demand is growing. It's moving in the right direction. It's just not as fast as in China. It's not as fast as it was. And I think that sort of damaged sentiment to some extent and caused some sort of build up in inventories.
Yeah, look, I'll be honest, we get to this now, Will. If I look at EV sales growth and then I look at gigawatt hours deployed linked to that EV sales growth, the gigawatt hours is good. It's in the upper 40s, my numbers, and looking at the data. So I don't see demand as a disappointment. ESS looks to me to be solid. We'll see how it ends the year. So for me, I guess I'm pointing a finger a little bit at very high prices of lithium and then suddenly seeing production coming out of areas I didn't expect. Nigeria, more out of Zim, etc. And I guess I tweeted about this the other day. For me, the canary in the coal mine is when you can ship 1% material DSO around the world and make money, then trouble's coming, because you don't need as much in terms of mine planning, and you can dig that stuff up and you can ship it pretty quickly. So, to me, that's a risk that you're nearing a top when that stuff starts moving around the world. But your thoughts on, I'm hearing even Angola, there's also Ethiopia. Your thoughts on all of this material production popping up in Africa.
Yeah, so and I think you're absolutely right. We're aligned on that. We did see that big increase, that big supply response last year. But then we were talking with prices at $60 or $70 or $80 a kilogram. Yeah, we're a lot lower than that now. We're in the sort of the mid-20s or below, and so that's going to make some of that material now, those sort of DSO materials, less attractive. Yeah, we're already seeing some supply response on the on cutbacks in China with the lepidolite operations coming. Some either cutting back or stopping. We're seeing some more announcements of processes going into sort of putting on care and maintenance as well. So there is a tightening up on the supply side now, which is part of this process of balancing the market. I think we've often said you can never underestimate the Chinese, and I think what we've seen in the last year is very much that they managed to suck lithium units out of into the market, which took people by surprise, and we're in the aftermath of that. We're living with that now. But it's the correction is starting to happen. We think, now because we're starting to see those cutbacks, we think the price falls will start to decline. The price falls will start to level out now. If anything, we're expecting a bit of a rebound into the final months of the year. We saw it this week. We've seen a slight pickup in our spot Chinese prices. And that's big. That probably, it's seasonally a strong time anyway. I think you've had the low price. We do know the market is very destocked at the sort of the CAM air level. You could only destock for so long. And as you say, the numbers, the growth numbers, the gigawatt hour numbers are still looking quite impressive. So that will mean that people will come back into the market, even if you're moving from destocking to hand to mouth buying. Then that sees apparent demand increase, and if prices start to move up, then you're likely to restock it. You'll see restocking as well, because people want to lock in these low prices before they do move up. And one of the factors of the market is because it is fairly illiquid, you do get some fast price moves, and that does mean that these swings from destocking to restocking can be quite energetic. So yeah, I think towards the end of the year, going from now onwards, we are a bit more bullish on the price. We don't think we're going to go back to where we've come from, but we do think we'll see prices get some lift.
Yeah, so that leads on to a couple of questions to chat about and things to chat about. So if you look at the Guangzhou futures, they've rallied, and the nearer futures, the January future, is sort of bounced, and it's now higher than spot for a change. The longer dated is still at a discount. I'm struggling to figure that out, because that is well below the marginal cost of production those futures are trading at. They're trading at sub 20,000. You take VAT off, it's even lower. So I'm not sure who can sell material at that price. So I guess the one thing I'm wondering, Will, is the Guangzhou futures physically settled. So you've now got, some pressure as you're coming to expiry, and you've had these maintenance cutbacks, and you've had stuff coming offline. September carbonate production in China was lower than August, and October's forecast to be lower than September. So could we see a bit of a pinch here as people have to deliver into those futures, and there's no physical to do so?
I still think there is there is inventory up at the sort of the processors level. So I think there is material to still to be destocked from upstream. So that material could be delivered. But I think you're also, the other point is, which is a sort of a supporting measure, is as we go into the winter months in China, we'll start seeing the sort of the brine operations start to, their operating rates will start to fall. So that's another sort of supporting factor as well. And so that's on the supply side, and on the demand side. Traditionally, the October or even September through to the end of the year are strong sort of periods for EVs. And if we see that repeat itself, then we'll start to see some of that OEM and dealership inventory come down, so they will be more inclined to boost production, and you'll see that sort of demand moving back up the supply chain more. But I think at the moment, as I said, it is the can manufacturers that are running with really tight stocks at the moment, living very much hand to mouth. So as soon as they start to get pick up in orders, then that should feed through into the upstream. And
yeah, because one thing I notice is on the way down, guys sell quickly and upstream, and then on the way up, they tend to hold back and squeeze everyone. So it's there's a bit of a sort of there is a strategy and a play the way the guys seem to do it. So I think you're right. I think as they restock, you might find they're not as quick to sell because the margins look to be extremely tight at the moment. You can only be bidding on spodumene in the upper teens to vaguely make a living with where spot is now.
Yeah, the actual outright spodumene price is still, relatively high. Obviously, it's come down quickly, but if you think where the lithium carbonate spot prices are in China at around sort of 165 RMB per ton, back in 2018 when we were just coming off the top of the market then, they were around that sort of level back then. At that time, you had spodumene at $900 a ton. Obviously, it went a lot lower over the preceding years. But so if you've got the sort of the lithium carbonate prices are at a similar level from where they were back in sort of early 2018, but you've got $900 back then, and now you've got 2,150. I think our last sort of spodumene spot price.
So that leads to an interesting question. If you've got new production coming on stream, how do you see the split in margins across the production line these days? It's all with the miner. Do you see the converters gaining some power back as more comes online, or do you think these initiatives to keep spodumene outside of China and do midstream and downstream elsewhere is going to be enough to keep them at bay, or do you think the balance of power is going to shift back again to Chinese converters?
Yeah, I think it's going to remain fluid. So I think right now, I think the converters in China, you've seen a rapid sort of fall. So if you look at sort of what spodumene prices were at the end of August, I think they were around 3,250 sort of dollars. So we've fallen down to 2,150 over a period of sort of 6 weeks or so. I think that's happened. You haven't seen that sort of a fall on a percentage basis in the Chinese sort of prices. So you've seen the sort of the Chinese converters have had a bit more margin because of the fall in the spodumene prices. When prices go up again, you'll see the converters will probably build up a bit more of a margin because the salt prices will probably move faster than the spodumene price to start with, I think. So yeah, you'll see a bit more of that. Longer term, yeah, I think we are going to see more of the Australian spodumene being converted in Europe and in North America. So that will be an issue for the Chinese, and I think that's one of the reasons. I think they saw the writing on the wall probably a year ago, 18 months ago, and that's why they've developed their own domestic lepidolite mining. I think that's why they've gone really heavily into Africa as well. They do see that sort of where their traditional suppliers come from, say in Australia, that is going to be diluted. They're not going to have, there's going to be more competition for that material, and therefore they won't be able to rely on that so much. And then you've also got all the sort of the geopolitical side of things as well. I think that's another sort of factor which is going to cause more diversification. So I do expect more Australian supply to go to Europe and to US as well.
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LIRC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com.
And Will, do you think, given what we saw as a response last time and these new areas coming out with production, do you think we're going to see lower highs in terms of price spikes going forward? We're going to see CME futures trading. I noticed the open interest has almost doubled in the last 2 months, and you see what's happening in the Chinese futures. And there's also, not that it's on an exchange, but I know quite a lot of spodumene trades. Are we seeing more hedging mechanisms coming in, and we're seeing more supply channels opening up, that we're going to see a tighter band in pricing going forward?
Yeah, so answer your first question, yeah, I think we will see lower highs. There is more and more interest in being able to hedge. As you said, I think the open interest now on the hydroxide contract on the CME is 7,500, about 7,800 or something lots. So that's picked up. You're often seeing volume. I think volume across September was generally over 100 lots a day. I think it's had a peak of sort of 100, 520 or something. So there is interest there, and certainly more talk during the LME week, which was this week, earlier on this week. There's more interest in that as well. It is early days still, but we do expect more liquidity, and as that comes, then that will give more hedging opportunities as well. Still think market's going to be prices, and market will be volatile. Lithium is a relatively small market, which is going to have to go very fast in a short space of time. There are a lot of moving parts in it. We're going to rely on a lot of new production from junior miners. There's a lot of things that can delay those startups. But likewise, we've already seen sort of producers coming on from a bigger, diverse area. So we've seen a lot more in Africa. And we should expect we've seen Brazil as well. But yeah, a lot of moving parts in it. So it's certainly going to remain volatile.
Will, how do you see, I'm seeing reports coming out about where Africa could sit on the supply curve and how much it could produce. Do you think that the prognosis and the sort of outlook for African supply is really as bullish as some think?
Yeah, I think it is. I think because I tie it back into the sort of the need for more diverse supply. I think when you get this partnership between sort of China and other countries, it does tend to accelerate the supply. A classic example of that is China partnerships in Indonesia in nickel, and how that sort of really changed the face of the nickel market. If we'd been talking, I was in 2018. We were speaking to people, and they were mainly concerned about nickel rather than lithium then. But that's all changed now because of that partnership between China and Indonesia and how quickly they've been able to do things. I think we're seeing the same sort of partnerships in Africa as well. And I think China needs that. It needs to diversify its raw material base, as we mentioned earlier on. So yeah, I think all these areas are going to be needed, and we're going to see other areas as well. We'll see India, we'll see Afghanistan, we'll see different continents and different areas coming in, and I think that's all going to be needed. But it will make it a more stable place. The supply base will be more stable. We won't have we won't have as many of the long supply chains, which, as we've seen with COVID and everything else, can disrupt supply. So it will all help to stabilize the market, which is the size of this market. Where it's going to go is needed. It's going to be a tall order for producers to keep up with demand. I think they can do it, but it's going to take a lot of resourcefulness.
So with that as a backdrop, Will, what is your long-term price assumption?
So yeah, we think prices as I say, to the short term, we think we're moving higher again. We think the 25, 35 dollar per kilogram is a comfortable range to be oscillating around. And I think, as I said earlier, we do expect volatility. We do expect, I think you get these destocking and new restocking cycles and they can happen within the year. So yeah, we expect volatility, but not the sort of the range of whatever it was, $7 to $85, which I don't think the industry can survive with that either. So it needs stability.
That's my next question. Is a price around 30, which is my number, is something I believe that is enough to incentivize new production to come online, and it's enough that the OEMs can still make a decent profit margin and a happy place to keep new supply coming on and to keep the OEMs well stocked. Would you agree with it?
Yeah, I certainly would totally agree with that. And I think within the volatility of that, when you have that volatility and when you have a futures market with sort of liquidity, people can do their own independent pricing. So if they're all buying and selling off an index price, that you can then go and actually lock in your prices when the price suits you. So if you say the average price is going to be 30 and you do get a 22 and that suits you, then you can lock in at that 22. And that all off basis your hedge. And then you can, likewise, if you're a producer and prices go up above that, then you can also use the exchanges to hedge that risk.
So we've seen quite a lot of M&A in the industry, and guys doing it, I guess. Do you still see a high importance of the downstream securing both supply and price, and ideally tier one jurisdictions as the country of supply?
Yeah, I think there is an awful lot of interest to secure supply, not necessarily lock in the price, but I think actually securing the supply. And again, if you have a lot of the because of the sort of the impurities and things like that, I think it makes a lot of sense to know where you're going to be getting the same sort of material. So that makes sense. And I think the really important part of M&A and the whole of that area is it's because this industry is growing so fast. And because China has got such a sort of advantage in they've been doing it for so much longer, there is a shortage of know-how. And I think that's M&A really helps will help the sort of the supply side to combat some of the hurdles and the headwinds that things like lack of know-how, haven't done it before, experience and things like that. So I think M&A is going to be helpful in enabling the producers to keep up with the demand.
Talking of know-how, do you see a sort of mid to long-term risk of battery-grade lithium supply ex-China as rest of world tries to diversify and do conversion outside of China? Is there a risk that it takes them longer and there's teething issues and so on to getting up to speed?
Yes, I think even the incumbent producers, when they expand, run into issues. I think the more experience they have, and I think that will improve. But certainly, totally new producers, I think you have to expect that there will be ramp up issues, and it'll take time to get the quality there at a steady state of production. And those are all headwinds that the market needs to contend with. It is. And what we're seeing is some of the producers who are, in Asia are setting up shop in Europe and in North America. That means that hopefully with that will help to reduce that amount of startup issues as well. But yeah, I think you have to expect, especially in lithium, it has quite a history of suffering, and I think you need to book that into. Into your formulas.
Your thoughts on guys are looking at doing an intermediate product on producing a lithium sulphate?
Yeah, no, I think that makes a lot of sense, and I think we will see more of that. I think it ticks more sort of ESG boxes. In some of going back to the Africa thing, you've got some really landlocked countries there. With thousands of kilometers of transport, I think it does make sense if you can to produce an intermediate, and I think that it will take less pressure on the transport system, And I think it's more environmentally friendly potentially to be imported into the likes of.
I was about to say, my guess is somewhere like Europe, that might be a preference for them.
I'd say so, yes.
And linked in with that, Will, do you think we're going to see a bifurcation in pricing? Do you think we're going to have two-tier pricing?
Yeah, that's a question a lot of people are asking. It's with the US IRA, if only certain material can be used to qualify for the to be compliant with the IRA, it could well be that there is a premium on that material. Generally, if you talk to the consumers, there's no way they will accept it, that's always going to be the case. But again, in Europe, the cost of producing in Europe is going to be more expensive than the production costs in China. So either tariffs or cross-border changes, leveling up. So yeah, I think that in one way or another, there will be higher prices, I think.
And Will, just as a final one of the key things to my mind for EVs to reach the penetration levels that they need to make the difference and align with the whole clean energy, etc., is you need to have more alternatives and choices in the low to mid cost end to really make the shift, because certainly in my part of the world and elsewhere, the average price of a new car, and even in China, would have you substantially below where it is in the US and Europe. Do you think that the Tesla and BYD seem to be on top of their game, and some of the other producers, but with those two, if you look at what Tesla's producing for, hopefully they'll get to whatever they called it, a Model 2 or a mid-price. Do you think all of the large incumbent OEMs are on track and doing enough to be able to make a living and sell into the sort of mid to low cost end, which is the real S-curve to EV adoption?
Yeah, I think it is still early days in that sense. I think you've got people looking at, you've obviously got sodium-ion batteries. That's sort of one area, but I think in time, what we'll see is that we'll probably end up having vehicles with smaller batteries, and that can happen and therefore that will reduce the cost of the car. But to go hand in hand with that, you do need the charging infrastructure. So these things are all working in parallel, and I think that's how as you say, the overall cost of the vehicle can come down to make it really affordable to the mass production. Plus, in time, you're going to get more recycling coming in, so that's another sort of aspect, I think, which will help as well. So yeah, I think we have to get there. I think we will get there. But I think it will be a combination of lots of different sort of changes.
So just if I can ask one last one, because I always have people outrage and tweets and whatever when I put down EV sales and they say, oh, but that's plug-in hybrid with full battery. The purists are all, it's only BEVs that count 100%. But I keep trying to explain, in my old hometown of Cape Town of over 4 million people, there are 30 public chargers. Plug-in hybrids are going to clearly be an interim step till you get infrastructure up and running, because a lot of the developing world's going to need another 15 at least years to do it. So do you see plug-in hybrids remaining will they remain an important part in the developing world?
Absolutely. We very much see it as an intermediate step, but one which will last. And what's really interesting is if you look at what's happening in China, actually. So some of the vehicle numbers there, if you break it down, you're seeing much stronger growth in the plug-in hybrids than you are in the battery-only vehicles. And a reason that is, a lot of the sort of tier 1 and tier 2 and tier 3 cities have a much larger sort of EV population. So the EV sales are now going into the lower tier cities where the infrastructure isn't so much. So even in China, which is leading in the sort of the whole EV race, you're seeing demand for plug-in hybrids growing at a faster pace than battery-only vehicles. And I think that's a really interesting development. Excuse me. So I think that's a model we will see across certainly across the sort of the less mature markets.
Okay, great. Adams, thanks very much for coming back on for, we think, your fourth appearance. Great to see you. And I guess any last surprises or anything that we have missed or should keep our eye out for from Fastmarkets side with what's going to happen between now and year end in the lithium market?
Yeah, between now and year end, I do think we will see a slight pickup in prices. I think we will start to see a bit more of a restocking rally. So we've covered those areas. I'm not really looking at any other sort of areas of surprises, I don't think. Hopefully we can be a little bit more, the market will be a bit more cheerful.
Yes, it's the way I see it. I'm surprised it's lasted this long, but there it is. There have been a couple of areas of supply that I've been dismissive of that have turned up. That's the missing number, but I'm hoping from your mouth to upstairs that we're going to get a restocking rally shortly. It looks like China's trying to push some stimulus as well now. So they're looking to kickstart things. Hopefully that follows through. So thanks very much, Will.
Great. Thank you. Thank you, Rodney.